Good afternoon, everyone, and welcome to the Fat Pitch Podcast. I'm your host, Paul Borowski, Chief Distribution Officer for Sealy Investment Securities, and I'm joined, as always, by my co-host, Clint Sorensen of Wealth Shield, Akari, I think 27 other items. Clint, great to have you here this week, and great to have this week's guest with us, Aaron Dillon of AG Dillon. Aaron, welcome to the Fat Pitch Podcast.
Thanks, Paul. Thanks, Clint. Appreciate you guys having me.
I'm thrilled. I always wanted to learn a little bit more about VC. Would you tell everybody a little bit about your background and how you ended up founding AG Dillon?
Absolutely. So first, thanks for having me. I appreciate it. So AG Dillon Co. is a venture capital firm, right? We focus on helping RAs and independent broker-dealers access venture capital-backed companies for them and their clients, right? And yeah, a little bit about myself. So I kind of started my career at Morgan Stanley Wealth Management in the home office, like building financial products for advisors. I had a stint at TD Ameritrade where I ran the mutual fund and ETF business there for both the RA channel and the self-directed channel. And then co-founded an ETF company called Crane Shares ETFs, which is a great business. It's a China-focused ETF company. Today, it has about $10 billion in assets under management. I was able to hang in there for about 3 years. We weren't taking paychecks, right? So I hung in as long as I could. But it's an incredible company, still own the equity. And had a few other stints, but one that kind of probably sticks out was a firm called Galileo. It was a bank account technology business that ultimately got bought by SoFi, and then SoFi went public. So I've had these kind of like, I had a lot of stock in Galileo, thankfully, and I had these kind of private stock events or private stock market events that impacted my private balance sheet. And that really kind of lit a fire for me for venture capital. So that's the motivating factor for driving or kind of starting AG Dillon Co. I really wanted to help RAs and IBDs access this asset class for their clients so they could hopefully have the same type of benefits.
Well, yeah, now you're helping bringing it more to the high net worth and qualified assets and individuals. That's terrific. Clint, you and I spend so much time talking about private markets, whether it's real estate, credit, hedge, venture. I'm sure you spent a fair amount of time talking to Dillon. What's on your mind right now, both of you, about, the VC market?
Yeah, first I'd like to say, Aaron, tell some folks something that they don't know about you if they've heard you before. So you went to The Ohio State, right?
That is true. Huge Buckeye fan.
I didn't know that. This podcast is over.
Yeah. And what sport did you play there, Aaron?
Yeah, so I am, you can't tell on video, but I'm 6'4". I played volleyball there, which, believe it or not, is a varsity sport at Ohio State. And it was fun, man. Yeah, we went to the national championship, actually, my freshman year. We lost to UCLA and then lost to UCLA again in my sophomore year. So those guys had our number. But, yeah, second place my freshman year, and then I suppose tied for third. And
so were you a setter or a hitter, or what's the vernacular?
No, Paul, I was the shortest guy on the team. There was one other fellow that was shorter than me. At 6'4", I didn't quite make the cut. So I was a defensive specialist, believe it or not.
Right? You spent a lot of time diving around.
100%. Most of my life has been on the floor, right? So yeah, it continues that way.
I got it. I can tell that he's not an Ohio guy, but a New Yorker.
That's right. Yeah. Sure. Yeah. 20 years. I'm 20 years in New York now. So on the island here. So if you ever come through, anybody, you got to come and see me.
Well, as we set the stage for discussing VC, I think it's important that we all recognize, unfortunately, how strenuous and how tough and how adverse the capital markets have been over the last, feels like a long time now, but really about 18 months. And I myself spent 12 years in New York. I moved down to Texas during the middle of the global financial crisis. I said to everybody, hey, I can go broke more slowly here.
Smart.
I hope that's not the same case. What is this current environment doing to the VC space? What have you seen with all of your experience? What do things look like?
Yeah, look, venture capital is arguably one of the more riskier asset classes that you can be in, right? So naturally, I think, assets flows have slowed down a little bit into the space. That certainly industry metrics have proved that out, right? But of course, not all venture capital is the same. There's very early kind of venture, two guys in a garage type venture capital. And then there's the stuff that I invest into, which is this late stage venture capital company. So it's companies like SpaceX and Stripe and Instacart and Canva, Databricks. I mean, these are huge businesses that have valuations that are north of $10 billion, right? So like if they were public, they'd be in the S&P 500, right? So very different risk profile for those businesses. But you are right, Paul. Like in general, across the broader venture capital space, the flows have slowed down a little bit, right? So I think it's akin to probably what most asset managers are seeing, right? Is kind of a shift towards conservatism.
Clint always talks about this. That's when quality matters, right, Clint?
That's right. That's when quality matters. So talk about some of the quality companies. I love the fact that he said that a lot of these names would be in the S&P 500. They're that big. When you think about it, like traditional venture, you're thinking two guys in a garage come up with a great idea, building an app.
And a dog, don't forget.
Yeah, the dog. Yeah, but the companies that Aaron's dealing with, which I think is really compelling for advisors, especially, they're big enough to be in the S&P 500. And I think that's that's something that's vastly different than it was before. So maybe Aaron, dig a little bit into that.
Yeah, is that new, Aaron? Is this size thing?
It is new. No, you're absolutely right, Paul. So yeah, I would say in the last 10 to 15 years, this motivation for large kind of venture-backed companies to stay private for longer is definitely a thing. I think it's a testament to just some of the trends that are happening just in the broader capital flow space. So a lot of pension endowments and foundations continue to allocate more and more and more to alternative investments. Venture capital is a part of that. And I think, increasingly, as you guys know, you guys deal with a lot of advisors, right? Advisors are in the alternative space, and family offices are in the alternative space too. Of course, the venture capital is getting the benefit of that. So I think as more and more capital enters the space, both from the equity side and the debt side, the venture debt side, I think it affords these folks the opportunity to stay private for longer. They can still continue to grow, right? That they've wanted to or could.
For all intents and purposes, there hasn't really been an IPO market for over a year, right?
It's been locked up. So, now look, it is a coiled spring. So I think for some of these companies, when the window does open, they're going to go, right? Like Instacart's like one of those companies that's out there. It looks like they're going to go as soon as they can. So, there's some interesting dynamics too. You got your investors, venture capital funds are typically 10-year funds, right? The kind of old school traditional venture capital funds. If you've been in a company for 12 years, your LPs are a little antsy to, realize that gain, right, and get the cash back. So I think there's some dynamics like that. And that's why some of these companies would actually go public, is to get liquidity for their existing shareholders as opposed to getting capital to help them grow, right, which is maybe what the case was prior.
So if I'm layman on the street, you hear about, hey, this guy got a hold of this guy got to invest in this company. How does someone like you and your firm get access to these exciting companies?
Yeah, so first of all, what I would say, Paul, is if someone calls you up and gives you the old Brooklyn, hey, I got a guy that can get you some SpaceX stock, right? You are probably getting your face ripped off on that trade. So I would call somebody who knows something about this space to make sure.
Am I getting a piece of a bridge in Brooklyn also?
No, you might be getting the stock. You're just not going to get a good price, right? And I think that's the key thing is in this pre-IPO space, you can shop your buy, right? And get a good price. You just have to know the right people, right? And it's not impossible to do that, but it does take some time and effort to develop these relationships with what I would call institutional traders. And then they have a really good, kind of a good pulse, thumb on the pulse of this market. But the offer on average that I've seen across the 7 institutional traders that I work with is usually 25%. That's the offer. That's not the bid-ask spread. That's the offer, right? So you really got to know what you're doing. There's a lot of counterparty risk in the space too, right, Paul? But that's it. But yeah, and these institutional traders are the right place to go to. They're a little cagey because, as you can imagine, there's a lot of flakes out there. And when they do go to trade and they run down a trade for you, it's a lot of work for them to do that, right? So they kind of like to deal with what I call real people. So you got to commit the time and the effort to develop a relationship. If you develop the relationship, they'll be good to you. You'll get a good price.
Talk about your index, Aaron. So you've got an index of a lot of these large companies, which I think was unique. It comes from obviously your ETF and public market.
Does this mean, when you say index, do you mean benchmarking or do you mean an index?
So it's a little bit of both, right? So I'm a big passive investing guy, right? Especially on an asset class perspective. I like diversification, right? I like rules-based methodology, a little less human emotion in there, right? So that being said, and having worked at an index, I worked at FTSE Russell for a number of years, started an ETF company, right? So as I moved into this asset class, I kind of felt like there was an opportunity to create indexes that aligned better the way that people actually invested into the asset class. So, traditionally, I think people are familiar with the S&P 500 or the Russell 1000. It's kind of a rules-based methodology. It rebalances every year, every quarter, every 6 months. It reconstitutes every year, right? New stocks come in, stocks come out, every year. That's fine in the public markets where there's liquidity. It just doesn't make sense in kind of the private markets, right? At least for venture capital. So I kind of set off to build indexes around that. And again, venture capital is also built by vintages. So you can't really rebalance. So I basically every quarter, and I went back and back tested this for the last 42 quarters, I believe I have now. So I have 42 individual vintage indexes.
Hey, describe that, Aaron, just for the audience. What's a vintage?
Yeah, so a vintage would be as if, like, let's say the three of us got together and said, hey, we're going to take some money and go and buy 15 pre-IPO stocks, right? So I have a rules-based methodology. In this case, it's the top 15 pre-IPO stocks by valuation using their last primary round valuation in global developed markets. So no China, no Russia, no Brazil, right? No India. So that's the rules-based methodology. If we go out to market on, January 1st, 2016, and we apply that rules-based methodology, we identify the 15 names, we buy those 15 names. And then in the way that my vintage indexes work is we just hold those, right, until they either IPO or acquired. And if they're still private, I'll just continue to value them going forward. And that's the vintage. And that mirrors real life. That's how actual venture capital investing works, right? More often than not, people are not selling the companies that they hold in the secondary market, right? So that kind of gives a nice snapshot. And I've done that, Clint, every single quarter. So if you imagine, it's the same rules-based approach every quarter for 42 quarters. And I take an average of that so that, you can either look at each vintage. I made an investment in second quarter of 2017, into a venture capital fund. And Paul, to your point, that could be used as a benchmark. Right? Or you could use it as an investment philosophy. Say, does this rules-based methodology work? If I put X amount of dollars into a strategy that follows that rules-based methodology every year, this is the return profile that I could expect to receive. So that's the purpose of the investment, Clint. I use them for that purpose. I have this investment strategy that is just that. It's intended to be the top 15 stocks by valuation, and having 42 quarters of back-tested performance, I think, gives investors some comfort.
Yeah, so question for you. That's obviously a very, quantitative, looking at past track record. Do you do any qualitative research on these companies?
Yeah, so I do a qualitative, especially on the ones that I would call like in my coverage area. So it's kind of like if you put your stock research hat on, right, Paul, and you took a look at it. And the nice thing about some of these later stage companies is there are a lot of public information out there about them, right? So, but of course, I subscribe to a lot of very expensive market data, right? So if you ever need anything, give me a call. I'm sure I can help you out instead of buying it yourself. But yeah, we'll look at that data. We'll pull all that together. We'll also take information that's out there publicly in the market, either it's from a new product perspective or number of users, et cetera. And we publish reports on the top 15 companies by valuation for those stocks too.
Very cool. I got a question for you. I've been thinking about, especially coming from the real estate side, our debt keeps getting more and more expensive. Talk to us about if these companies are staying private for longer and they may not want to be living off of their P&L, they're not going IPO. What do they do in terms of debt? I mean, I'm sure it's got to look different than it does from a real estate guy's perspective.
It's certainly, I think, a riskier asset class than real estate, right, from a banker's perspective or a lender's perspective. But there's definitely debt out there. I think for the companies, every company's different. Obviously, has a different risk profile. But it's certainly happening. It's not as cheap now that the Fed funds rate's at like 4.8%, right? But it's certainly happening. And venture debt's a little different too, Paul. Typically it's more of like a bridge loan, right? To get from, where they're at today to the next kind of primary financing round. I think you'll see a lot of folks will tap the debt markets if they don't like where the equity market is at any given point, like kind of like a scenario where we're at right now, like valuations have come down. So they don't want to go out and kind of do a formal print in the primary financing round or primary market on a valuation, because that would kind of post a decreased, or they call it down round, right? From a venture capital perspective. So you do venture debt, and hopefully that'll get you to a place where the markets have improved and they can go out to market and then continue to show that nice, kind of smooth valuation increase in their company. So that I think is what's happening. So the short-termism of that loan, or the shorter term of that loan, I think maybe makes the interest rate less important, right? for these companies. But yeah, so venture debt certainly has a place, I think, with a lot of these firms.
Terrific.
Now, Silicon Valley Bank was the big player in the venture debt space, right? So I know they, and you're seeing credit lock up across the spaces. All this deposit outflow from regional banks, you've got to think this is going to present or manifest into further opportunities on the equity side. I mean, don't you think with valuations coming down and bound to come down further for some names that need to raise capital, I mean, don't you think they're going to continue to have down rounds? So it presents just an amazing opportunity. I mean, some of these companies are they have a ton of quality, but at the end of the day, they just have to raise capital because they're growing so fast, and they've got to be able to deploy it. And so if they can't go to the debt markets like they used to, maybe some of them still can, but credit's locking up, man, it's got to present a really awesome opportunity for good terms for equity investors. What do you think? What are you seeing?
I would say a couple of things, Clint. So one is for investors that are living kind of in this market, those opportunities are already there. So like trades that are happening on the secondary market are happening at what I would call real valuation levels, right? The company may not be going out to the primary financing round, but the secondary market, and I would call like institutional investors, are very much akin to like, look, this company's not worth $40 billion anymore. If you look at their peers, the publicly traded peers, other people in the space, they're all trading down here. There's secondary market trades that have happened, at these kind of depressed valuations. There's also these things called 409A valuations. So if you're a corporation and you have an employee stock option plan, the IRS requires you to value your company or have a third party value your stock and the valuation of your company every year. Some companies do that every quarter. Instacart's one of those where they do it every quarter. So that's kind of a good, nice stamp, a valuation stamp for you to take a look at. So there's definitely ample opportunity out there. To your point, some of these companies are very high quality, double digit or more annual revenue growth. They're tightening up expenses just with everything that's going on. So they've done layoffs or they've gotten real tight on expenses. So kind of increased net income, right, are kind of margins. But their stock prices are down. So in some cases, down like 50%. There's one company called Deel, D-E-E-L, right? It's like an HR company that helps U.S. businesses hire foreign like developers, really, tech folks, and they'll manage all of the taxes and the legality and everything of hiring those people for a U.S. company. Their revenue's up north of 400% in 2022, and their stock is down 50%. So, that's a company with just about a $10 billion valuation. So like there's some just incredible opportunities in the private markets where there's just this massive dislocation around quality versus actual stock price.
All driven by liquidity too.
It's all driven by liquidity. You got it.
I mean, anytime you get that liquidity, drain on liquidity, it seems it just runs the gamut from everything. Your business cycle, Clinton always talked about this, your stock cycle, your credit cycle, and it's a vicious cycle when you're all said and done. Another everyman question from me, as Clint's heard me say, the guy in the half of the class that made the top half possible. How much of the VC world is tech related? Is it half? Is it 70% of you deal with 90%?
Yeah, so I would say VC-backed companies have to be companies that have potential for like a 10x return, like 10,000% returns. The companies that start off like two guys in a garage, right? Start off and get the VC funding have to have this thing called a huge TAM or target addressable market, right? You got to change the world. They don't want to invest in companies that are going to do like, 10% year-over-year revenue growth.
Technology.
100%. So like businesses that can scale like that, Paul, have to be usually technology or really software. Yeah, like software driven, like not even hardware, really. It's really software driven. I mean, there's exceptions, of course, with like Elon Musk and what he's doing with SpaceX or Tesla, right? Was another venture capital backed company that was like physical items. But by and large, these are software companies, right? You do see some venture funding in the biotech space, right? So you'll see some more science-driven type companies. Pharma companies are also kind of receive VC funding. But those are, capital comes in, and if something hits, it can be a massive move, right? The things that are hot right now, just to kind of hit on a couple trends that are happening in the VC space, it's AI. AI is massive right now. Almost every company, whether you're a fintech company or a software as a service company or any of these businesses, they're all integrating AI into their business models and their product set. So I think if you take a look at where the capital's going, early stage capital going in the next like 10 years, everything's going to have AI in it, right?
Yeah.
Coming down the pipe. So that's the latest trend as of
this seems like
since ChatGPT went out in December.
This seems like such an exciting space. Like, I just don't understand why any advisor would be talking about public markets when they could talk about this. Now, talk a little bit about how you designed your product, right? The index, the way you help advisors get access to the market, understand the market. You really did it with the advisor, the independent advisor in mind. I mean, I think it's such a fat pitch for advisors to be presenting this.
Yeah.
Before Aaron answers you, I just wanted to make the comment. I'm sure also for some, it's just not going to be suitable in their portfolio, right? I mean, it's just going to gravitate towards high net worth and higher. I mean, I would guess that's the first line of demarcation.
So the funds that I run are for accredited investors only, Paul, to your point. So that's kind of $1 million of investable net worth or more, right? So yeah, so that's certainly the case. Plus it is a liquid, it's in a liquid asset class. So if you got clients that need access to their cash, this is probably not the space to be in. But to Clint's point, I think for those that have that type of investment horizon, or maybe, Paul, it might be more appropriate for someone's IRA account, right? If you want to think of somebody who's not heavy in the alt space, that might be
thinking long term and thinking if it goes up, thinking that it's going to be a higher return, risk reward profile.
You got it. That's exactly it. So look, but Clint, to your point, I worked really hard to build this business around the advisor, right? I mean, naturally the funds are for end clients, right? But it's a tip of the cap. The way that I built the funds and structured the funds is to make the advisor's life easy, right? In accessing this asset class and help them meet their fiduciary responsibility. And also too, these funds are built for individual people. I think most alternative funds are built for pensions, endowments, and foundations. And you just kind of like, yeah, sure, I'll take some family office money, or yeah, sure, I'll take some RA money, right? But it's not the primary focus. So I think when you start with the fund structure that's intended for an individual person, and then you kind of work from there, you end up with a fund structure that looks very different. So like just to hit on a few examples. So the funds that I run are called 506C funds. So 506C fund, I could run a TV ad to market the fund. Most private market funds are 506B funds. So you have to really know somebody, right, to get in. And so it's very different. So advisors love that. They can stand in front of a seminar. They can post something on social media. They're not running afoul of any of my issues. They don't have compliance issues themselves. That makes it much easier for them to sell. It feels more like selling a mutual fund or an ETF for them. So I think it's
and back to what Clint said before there's a lot of excitement around this area. I mean, you hear about these names, like I said before, hey, I heard so-and-so got into this and they got into this. So I'm a little older than you two fellas. I was in New York City during the first .com bubble, right? With pets.com.
Oh, yeah.
I went into, I think Merrill was the lead on that. I don't remember who the lead. They were in it. I got my puppet in an office. Remember the dog?
Yeah.
With Mike. By the way, it's kind of funny that Chewy's just the same company.
It is. It really is.
Yeah, it has success.
Just too early. Too early.
So, but to get at that, it's like you always hear, hey, why did this person get that or they got that? So the fact that you can take an exciting sector with opportunities like Clint said now and try to build it with, I'm going to say consumer and investor in mind, that's a very noble effort. I don't know what other
but Paul, too, I mean, to that point, I mean, and I'm sure you've probably seen this, everyone's gotten that call, right, where it's like, I got a guy who's got shares, you got to make a decision now. I mean, I can't tell you how many advisors I talk to be like, I would love to get my client into names like these, into this asset class, but I'm a fiduciary and I can't do this in 24 hours. These people call me up and you got to make a decision in 24 hours. I can't move that fast. That's where we've built this company. It's to help advisors go through that process. Most venture capital firms won't call on an advisor at all. They call in, no one calls them back. No one will come and see them. All of these things that advisors need to do to meet their fiduciary responsibility, there's no venture capital firm that does that. So that's what I'm hoping to do, for advisors, more and more advisors is, they need me to come and present to the investment committee. No problem. I'm there, right? You want me to come and talk with your best client about the state of the venture capital space? I'll do it. You want to do a seminar or a webinar so that you can go out and promote and hopefully drive new client acquisition and new households into your business? I would love to do that, right? So those are the kind of things I think you'd see like a mutual fund company or an ETF company traditionally do with advisors. And that's what I'm doing, just for venture capital instead.
You mentioned some of this before. For an investor who's already experienced with alternative investments, right? They've looked at the more, what I would call the basic food groups, oil and gas, real estate, credit. They kind of know this VC's out there. To your point, they've gotten the hustle phone call from a 917 or 212 or 646 area code.
Yes.
How you doing? You know, what are some of the things that the average Joe should look for in a VC company? Not just all the time, too, in light of the market environment we're in. I think I'd ask both of you. I would really ask both of you, but you first, Aaron, living in this every day.
So look, I would highly recommend that folks look at the late stage space. And I know that's self-serving because that's what I do. But I would look at the late stage space. And the reason for that, Paul, is someone can tell you what you're going to get before you invest in the fund. So if you went to an early stage venture capital fund, you're believing in someone's investment thesis and investment methodology and kind of their historical track record. You have no idea what company you're going to buy. So it's a little different than like public market investing where someone can be like, look, you know, I'm this person. I ran this track. I have this historical track record. We're running this new strategy. You're like, okay, this guy's good. They're going to buy these stocks, right? I know what they're going to get into. Like I have an understanding of that. You're talking about kids in a garage, two people in a garage. And they don't know what the next business is going to be of two people in a garage, right? They might be able to say like it's fintech or it's biotech or whatever, right? Or it's SaaS, it's software as a service, but they don't know what's coming down the pipe. So this next tranche of entrepreneurs might be garbage. Maybe they're great. Maybe they're great, but the manager, you know, doesn't live in the right part of the country to get access to those people, right? I mean, it could be any number of reasons. So I'm not saying that that's not a great place to be. I actually think early stage investing is a great place to be, right? But if you're an investor and you want to have a little bit more control, especially if you're new to the space, which is your question, right? If you're kind of your average Joe coming in, I think it's nice to know what you're going to buy before you buy it. And when you're in the late stage space, you can literally say, I want to buy SpaceX. I want to buy Instacart. I want to buy Stripe, or I want to buy this basket of names. And you can do that. You can do due diligence on it. You can understand what you're getting ahead of time. You can negotiate fees properly with the fund manager. You can understand the terms of the fund, and then you can invest. And I think you get a lot more control, and it's a much better risk profile for you.
Yeah, no, I want to follow up on that. And so when you're thinking about these companies, too, I also like it from the timing perspective, too. Just when you see the general trend in the overall market, a lot of these names down. What's your index down if you looked at like a vintage started maybe pre-22, so late 21? I bet, you know, what do you think your index is down from that point?
Yeah, so you're talking about the broad-based index, Clint?
Yeah, just your broad-based VC index. I got a point on this I want to ask.
Yeah, so since 22, it's probably down, or since 20, it's probably down 50% on average, yeah.
Yeah, so think about that. You've got exciting names, growing businesses, large names, but because of liquidity preference, which is really what we're witnessing, we just talked about it, right? People have a preference for liquidity. First, it starts at banks when you raise interest rates, then it trickles down to investors in people, right? It always trickles down. And so when you see this liquidity evaporating from the marketplace, these names down in such value, but still having growing businesses, it seems like that's a great narrative for an advisor when otherwise you're talking about public markets that have been rather choppy, not really great valuations. I feel like that disconnect this year has been the most apparent. So talk a little bit about how, you know, the quality of some of these names. And let's go through the example you brought up. I saw you on a panel in Atlanta, Nalt's panel, and you were talking about high net worth investors or advisors and how they were using these type of, you know, names, right, to raise capital and to attract liquidity and to have this, you know, readily available for pouncing on this marketplace. I thought it was a great strategy. So I thought that was a lot, but walk through kind of, you know, some of these names, high quality things you've done with advisors, because I think it's been great. I've seen it right from afar, but I've seen it.
Yeah, so I would say, well, let's just on the point on the liquidity, because I definitely think you're right. There's definitely a liquidity premium, right, to the returns or potentially you could get. But Clint, what's interesting, and this is like the dirty little secret, is in this late stage space, you can sell this stuff in the secondary market. So you can buy it on the secondary and you can sell it in the secondary, right? So you're getting this benefit of this illiquidity premium, right? But it's liquid. It's a pain to trade, okay? But that's why you get a guy like me to do it for you, right? So you don't have to worry about it and you can get best execution. But that's the key thing is like you can get in and you can get out, okay? and you still get the benefit of that liquidity premium. Right. So I would just offer that. Like I wouldn't shy away from the space for any given reason. I think this late stage space is pretty special. It's really a proper shadow stock market, I think. Okay, to the public market for the size of these companies. But
I mean, how does venture perform historically versus broad market?
On IRRs are like the kind of the top quartile is 20%.
I assume VC is going to be a lot like we see in real estate, which is the difference between top quartile and bottom quartile. It's the difference from Pluto to Jupiter.
You got it. In the late stage space, it's a little different, right? Because there's less companies just totally failing. Like in your average,
you're not GTZ.
You got it, man. So like there's this idea in venture investing called the power law, right? You can like Google that. So if you have basically if you're a startup, venture capital investor, you have 10 companies you're investing into. 5 of them will go to zero, bankrupt, right? 3 of them, you'll probably get your money back. 1 of them, maybe you get like a 2x return. And then the other one, you get like a 6 or 7 or hopefully higher, X return. And that one company delivers the full like 20% a year return for the entire fund. Right. So that's called the power law. That's certainly the case, right, Paul, is you kind of have this.
You also just made the case for being in a fund versus somebody trying to take the single home run, especially if you're passive and you have no input. So we're kind of winding down on our normal amount of time, but I got something I always love to ask people too. You're obviously an expert in your field. So when you are looking at a company, either for your fund or just as an armchair quarterback, something else, what are 2 or 3 major red flags for Aaron Dillon? Like no matter how good I think your business idea is, reminds me when I was single back in New York, there were some things that were big red flags. Yeah. Probably I had them for the girls. I know who mine were. What are Aaron Dillon red flags for these VC companies?
Yeah, so I think there's maybe 2 things I would hit on. And this happens maybe not in the late stage space, but certainly in kind of that earlier stage space. There can be some hot dots that people run around and chase after, right? So you got to be aware of that. Make sure you're not just getting the next sexiest thing out of Silicon Valley and throwing a ton of cash at it, right? I think that's kind of one thing. The second thing I would say too is you got to have, it's called CAC, customer acquisition cost. Okay. So that's the amount of money it takes to acquire one customer. And if that's really high for a company, you probably got a problem, right? That needs to be, there's this idea called product market fit. And usually when you hit product market fit, your CAC, your cost per client acquisition starts to come way down, right? That's kind of what it's really about. You need to find executives at companies that are really dialed into their target market, that are tweaking and building products that fit that market, that have product market fit, and they're being good stewards of capital. And every dollar that they're spending, they're maximizing the customer acquisition potential from that dollar that's being spent. So yeah, that's a red flag. If you see a company with a huge CAC, it takes them $3,000 to acquire one customer. That's even if they're growing quickly, it can be tough to
for our audience, don't get trapped into chasing a trend just because it's sexy, and essentially go beyond the burn rate. Look at what it truly costs to add an incremental revenue or customer.
That's right. Those are 2, and general rules of thumb. I think those are 2 good places to look at.
Yeah. Would AI be a really sexy thing right now that people are throwing money at without looking too deep?
It would be. And that's where, so I think it would be. And there's a lot of AI companies, right? So I think that's where it's important. If you're going to get in early stage, like if you're a late stage, you kind of already know who the winners are, right? Like OpenAI is going to be a winner. It's degrees of success for those folks at this point, right? Yeah. They got deals with Microsoft. So is it going to be a 2x return or a 20x return for OpenAI, right? Yeah. But, when there's 150 new AI companies that get funded in the next, in the past quarter or the next 2 quarters, like which of those are going to make it and which of them aren't? Most of it, like as discussed earlier, most venture capital firms go to zero. Funded companies go to zero, right? Venture-backed funded companies go to zero. But, I think it's good to understand which part of AI is actually going to work. I think AI is one of those trends that's here to stay. I do think it still hasn't quite worked out how, from an investment perspective, where you're going to be able to capitalize on that opportunity.
How does it make money and who makes money? So, Clint, you want to ask Aaron a final question today? I got all as always, mine are the dumb guy questions. Ask a smart guy question.
How do advisors get in touch with you? How do they learn more about AG Dillon Co? Where can they find you? I think that's a good parting question.
Yeah, there's probably two great places to go. One, you can go to the website. It's agdillon.com, right? Or you can go to LinkedIn. If you go to LinkedIn, I publish all the research there too. So if you want to get a flavor of what our research looks like and kind of how we think about the pre-IPO space and just really kind of daily or weekly updates on the market in general, that's a nice place to go. And then we got contact information all over the place. I'm more than happy to talk.
I mentioned advisors. Can regular investors, high net worth individuals go look at that info too and try to learn up, if you will?
Yes. So since all the funds are 506c funds, it's all a lot of the fund information is publicly available. Yeah, on the website there. So it'll look and smell and act more like a normal, mutual fund or ETF company. It's same
you
type
got
of
me excited. I'm done with boring old real estate. I want to go learn about IPOs and VC. I'm telling you, a lot more people want to talk to you at a cocktail party than talk to me.
Well, listen, Clint asked earlier about advisors. I have a lot of advisors who are bringing in new clients with this. Like we have a SpaceX fund we're about to close up here in about a week or two. And this one fellow down in Dallas has pulled in, I think, at least 3 new household relationships just by offering the fund.
That's a lot of fun. Beats talking about how they're going to change the signage of Twitter in San Francisco and paint over the W.
That's
Make it Shiba Uni or Uni or.
That's right.
Hey, Clint, why don't you take us out for the week?
Yeah, thanks, Paul. Thanks, Aaron. Thanks for telling us about the fat pitch in venture capital, and in particular in late-stage venture capital. See, you help a lot of folks, a lot of advisors. So we're very happy to have you on the podcast. Thank you for your time. Paul, as always, you're an excellent host. Thank you. And here's to the next one.
Yeah, let's have Aaron back when the football season starts because I know my Nittany Lions are going to beat the Buckeyes this year.
I like that. Paul, we're all Big Ten, man. We're all Big Ten, so we got that done, right?
Okay.
Yeah, I like that.
All right. Thank you, everybody. We'll see you next week on the Fat Pitch Podcast.
All right, fellas.
See you guys.